Alright, so today's session is brought to you by Emerald Financial Group. Emerald exists to help traders and investors take on equities markets. We offer a range of services to help educate, support and motivate everyday people to get involved in the stock market. We offer a range of different services for different experience levels. Now, if you want to know more about us, you can click on the description below. There'll be a few links in there where you can go check out our website and see what we do. So today I have Sam Green with me here. I work very closely with Sam on our portfolios and equity research site. He's a very experienced stock picker and a derivatives trader. Once again, if you want to know a bit more about Sam, you'll find him on our website. You can read his bio, get a bit more up to date on who we are as well. But look, let's just get straight into it. Today's session, what we want to do is go through the market and talk a little bit about our view right now and just show you a couple of our favourite stocks as well. It's been a crazy year through 2020. Well, what a year, guys, really, if you think about it. But at the end of the day, we're back to where we were, right? We are back to where we were pre-COVID. And now, a lot's changed since then. In particular, we've got open doors to very accommodative monetary policy and fiscal policy. So the dynamic out there and the backdrop has changed dramatically in 12 months. And what we want to do is just dissect a little bit about what that means for things for 2021. So look, Sam, what's next? What's your view on the equity market? Where do you think we're going from here?
Well, thank you very much, Tim, and thanks for having me on. To be honest, it's very rare that valuations for stocks have reached these levels. It's only one time in the entirety of sort of modern market history that valuations or prices relative to earnings have come this high, and that was during the year 2000. Some people called it the dot-com bubble. I honestly think that we're witnessing similar things at the moment. Valuations are extremely high. It's driven primarily by tech stocks, and people are starting to question, this stock is trading on 50 years of earnings, 100 years of earnings, 1,000 years of earnings. Is it really worth that much money? And that's a very good question to ask. And for some of these stocks, they're not worth that much money, or they won't be in the future. You can say that a stock is worth whatever someone's willing to pay, and so someone's willing to pay that now, but will you find buyers at that price in the future? That's a very good question. And so I actually do draw a parallel between now and the early 2000s, because I do think that there are a lot of large or potentially overvalued stocks that are going to come down this year. On the flip side of things, I don't think it's going to be a major market crash as we've traditionally seen. You talked a little bit about stimulus, the fiscal, the monetary stimulus, the extremely low interest rates, the bond buying from, the Federal Reserve, from the European Central Bank, Bank of Japan, our own RBA. All of these are conspiring to help prices rise. So instead, I think we're likely to see a shift towards value stocks again. People are going to start paying attention to how much a company earns, what sort of returns they get in the way of dividends, and I think this could be a year where we see value outperform once again.
Yeah, absolutely, and especially that there's so much money, stimulus going on out there. Longer term, I would think that value stocks like your banks, your miners, your infrastructure type stocks are going to be the best gainers on the back of that, especially that a lot of governments are wanting to spend money on infrastructure. So I definitely agree with you there. I'm reading a lot of articles out there. Everyone's talking about that giant bubble bursting, and by the sounds of what you're sort of saying is we might get a bit of a burst in some areas of the market, and perhaps that will move money back towards value.
Yeah, definitely. If there is a large shock, even to one specific sector in the short term, selling can become contagious, and if there's a complete revaluation of tech sectors and things like that, definitely that'll be felt across the entirety of the market. But I don't think it's going to be a protracted sell down, like we saw in 08, 09 up to 010, 11.
Yeah.
I think it'll be confined predominantly to a few sectors, and the market selling will be fairly short lived.
Yeah. So then you get the rebound back into the other sectors that people are pretty happy about or optimistic about at that point of time. and that's fair enough, right? So, but yeah. So look, what are your favourite sectors right now? What do you think's worthwhile actually investing in for 2021?
Well, that's a very good question. You touched on the banks, and by banks, specifically Australian banks. Banks overseas aren't anywhere near as profitable relative to their size. There's a lot to like about Australian banks. Our domestic government bond yield curve has really started to normalise, where we have longer term rates starting to creep up while short term rates remain very low. And that's really, really good for banking. Essentially what they're doing is borrowing at short term rates and lending at longer term rates. So the further those rates move away from each other, the better it is for those banks. You've then got the expected housing recovery this year, which shores up their loan books. So we're quite optimistic, the banks, in 2021. And then there's also parts of the mining industry that we're very optimistic on. Iron ore prices are so high, we don't think that's being reflected in the iron ore miners. Even if they come down a little bit, the iron ore miners still represent amazing value for us. Gold prices we think are likely to continue rising from the current level. And again, we think gold stocks are undervalued relative to gold prices. In terms of specific stocks, we're quite fond of Fortescue in the iron ore space. We're quite fond of Northern Star, Perseus Mining, and really a bunch of names in the gold space. Newcrest just came out with a very attractive report. And then we move on to some of the sort of second tier metals. Copper, really strong year expected for copper. We think there's a massive lack of supply for the amount of demand that's expected to come in the coming years. And so there's a lot of copper stocks that we're taking a good hard look at. We very much like Sandfire. Oz Minerals is a bit overpriced for us. And then there's a few explorers that obviously have a lot of work to do. Developing a mine, especially a metals mine, is a lot of time and money. But there could be some stuff coming from the explorer space. Just want to touch on one of our more favoured stocks, Sandfire, which is a very large Australian copper producer. We really think that the market doesn't fully understand what they're up to. And they're priced primarily on the DeGrussa mine in Western Australia, which will run out of production probably in the a year and a half, 2 years' time. In that time, they'll make about $500 million from that mine. They're sitting on about $325 million in cash. So that's $825 million, and that roughly matches their capitalization at the moment. On top of that, they've got $40 million in other Australian listed stocks. They've got $200 million in Sandfire America, which is listed in Canada. And then they've got the Botswana copper project called Chukudu, which is expected to come online in about 2 years' time as well. So, just looking at the market cap, you're getting $250 million in additional shares and, another copper project for free, basically.
So there you go, guys. There's plenty of value left in our market at the moment, and there's many stocks we can talk about that have very cheap PEs at the moment, guys. Like honestly, but the market seems to really be liking these growth stocks still, right? Even though they're extremely overvalued. Go look at Afterpay. Ridiculous valuations there, guys, right? And who knows whether they'll ever get earnings up to where they need to get them to warrant their price. But there's this whole value space that Sam's talking about here. In the banks, still low PEs. In the miners in particular, you can find some real gems there. Sandfire. We've been following Sandfire for a long period of time, haven't we, Sam?
Yep.
I think we've suggested that at once in our recommendations.
Yep, absolutely.
Fortescue as well, one of our current recommendations that Sam's bringing up. Still value there. I think we're up a good 80% on that stock since we suggested it, including dividends. So look, as you say, value could become the new flavour again at some point this year. We've seen signs of that. I saw signs of that last year. We saw a switch back to value at one point. But the people still in the US just love going back to that tech sector, don't they?
They certainly do. It's very juicy. It's an easy sell. It makes a lot of sense to, I guess less experienced investors. It gets talked a lot about. You can read about it in online forums. And that sort of, investor discussion definitely helps the share price. But, to quote Peter Costello, there will come a time when early investors, large institutions decide to start taking profit in these spaces, and you don't want to be the last person holding it, basically.
Yeah, yeah. I think like the way I see it is that for me to be trading in those high PE over sort of bought stocks, if I'm buying in those areas, it's more of a speculation, and I'll be looking to get in and out in the short term. But stocks like your Fortescues, your value type stocks, that's what I'm holding for the long term, guys. So it depends on what you're going for. If you're looking to build a portfolio, something you want to buy and hold for the next 10 years, get onto your value stocks, hold less of your tech. It's about your weightings on how you risk your portfolio. But yeah, I think I agree with Sam. I think value is the place you want to be if you're looking to invest in the longer term at this point.
Absolutely. And there will always be high value growth stocks that perform well over a long period of time. There will always be diamonds there. If you bought Amazon during the 2000 tech bubble, you'd be doing extremely well now.
Yeah.
But as a sector as a whole, we're sort of underweight the higher value stocks, definitely.
There you go. All right, so we've talked about some of our favourite stocks. We've talked about some of our favourite sectors. Is there anything else you want to talk about before we call it?
I do. I think an important thing to address is people sort of preempting a major stock crash. You've really got to consider what's caused stocks to rally to this point, and that's 0% interest rates, quantitative easing, or central bank bond buying. Very, very expansionary fiscal policy as well. So large Western governments are continuing to spend way, way more than they're taking out of the economy. Those things are all still there. So what's caused the rally is these settings, and those settings remain in place. For that rally to end, I think we're going to have to see at least one of those major factors close. Here in Australia, we will be constrained a bit this year as our federal government reins in their own spending, but there's no indication that the US will. Governments in Europe are very unlikely to curtail their spending much, and I can't imagine a central bank raising their interest rates anytime soon. And so that sort of major correction, major multi-year sell down people are expecting could be a while off yet. It's always a possibility, but my biggest fear, or I think the biggest risk for markets, is if interest rates are ever lifted. And I think that's still quite a way away.
Yeah, and that'll be a blow to a lot of markets as well, by the way, not just the equities market. You'll see, obviously, a housing market as well. Another market that's got a bit of a bubble, a bit over leveraged. Higher interest rates are going to kill that market too. Mm-hmm. So none of us expect it to happen anytime soon, though, that's for sure.
Mm. No, exactly. The amount of debt that's been accumulated due to low interest rates, it becomes very difficult to reverse that. And we can talk about inflation. A lot of people think, well, they're going to have to start lifting interest rates to combat inflation, but we're seeing inflation. It's just not consumer price inflation. Mm-hmm. We're seeing risk asset price inflation. That inflation is going on. It's the reason why the S&P 500 is at an all-time high. It's the reason why cryptocurrencies, gold, most asset classes are doing extremely well, despite weak economic circumstances. We've got really high levels of risk asset price inflation, and central banks don't appear to be fazed by that at the moment.
So I think it's sort of a little bit by design, I guess, as well. Mm-hmm. We saw it through, especially in the US. If you look at the S&P 500 from the end of the GFC to where it topped out last year, most of that movement was US quantitative easing.
Mm-hmm. Absolutely. So I'll just get a chart overlaid, and we can basically track how the S&P 500 went up with the Fed buying government bonds, basically, and that's a process known as quantitative easing. Some people have said it's money printing, but that in combination with the federal government is what creates the money, basically.
Yeah. A healthy credit market, low interest rates tends to always lead to a healthy equity market, guys. go back and look at most big crashes in the stock market, you'll tend to see that interest rates have gone up, just a little bit prior to that crash. So that's a bit of a precursor at this stage to a major pullback in the market, I believe, as well, would be an increase in the interest rates or a tightening of monetary policy of some sort.
Yep, absolutely.
So I think we'll leave you with that thought, guys. Okay. So just to recap real quickly, we're still pretty bullish on the banks here in Australia. Mining, industrials, that sort of space, all interest at the moment. If you're building a portfolio, mainly looking at value stocks, obviously a little bit underweight tech and those sort of more growth stocks. But yeah, that's sort of where we're at the moment. So look, if you are interested in exploring a bit more about what we do, once again, there's links down in the description of this video. Just click down in there, have a look around, and don't hesitate to reach out if you're interested in talking to us. Thanks, Sam, for joining me today. Valuable information there for you guys to go digest. Thanks, and bye for now.
Thanks, Tim.
No worries.